All right, today we are diving into something called Dow Theory. This is the exact framework the pros use to really understand the market's bigger story. It's so easy to get lost in the weeds, right? Staring at the latest indicator, getting obsessed with just one candlestick pattern. But there's this framework, it's actually older than candlesticks, and it's been separating the pros from the amateurs for over 100 years. It's all about seeing the whole forest, not just getting stuck on one single tree. I mean, come on, we've all been there. You get caught in a correction that you were sure was a real reversal. You see that dip, you jump in, you think, this is it. This is the bottom. And then you just watch it keep on falling. Or you do the opposite. You panic and sell at the first hint of trouble, only to miss out on a monster rally. That's what happens when we misread what the market is actually trying to do. Well, the solution is to start understanding the market's big picture, not just zeroing in on single patterns. And that is exactly where Dow Theory comes in. This framework was developed by Charles H. Dow himself. Yep, the guy who founded the Dow Jones Industrial Average. Look, this isn't about trying to predict every tiny little wiggle. It's about figuring out what stage of the game we're in right now. So, this is the professional's edge. And the whole idea is actually pretty simple. Markets don't just move around randomly. Nope. They move in predictable phases. And if you can understand those phases, well, that's where you get your edge. So how do we decode the market's trends? Dow Theory gives us this brilliant, super easy to understand analogy. It breaks down all market movement into just three things: the tide, the wave, and the ripple. Let's break that down. First up, you've got the primary trend. Think of this as the tide. This is the big, overarching direction of the market. Are we in a bull market or a bear market? And these things can last for a year or even longer. So here's the most important rule of all. Your number one job is to trade with the tide. Don't fight it. Seriously, trying to swim against the tide is a losing game every single time. And you can see the power of that tide right here. Just look at the bull market tide from 2013 to 2018. That was a long, powerful push upwards. Now compare that to the bear market tide of 2008-2009, when the tide was just rushing out with incredible force. Knowing which one of these you're in, that's everything. Okay, so within that big tide, we have our supporting trends. The first one is the secondary trend, or the wave. These are the corrections or rallies that go against the main tide, and they usually last a few weeks or a few months. Now listen, these aren't reversals, they're opportunities. Then you've got the minor trend, which is just the ripple, all that daily fluctuation and noise that, honestly, most of us should probably just ignore. All right, now for the main event, the 4 market phases. Seriously, understanding the cycle is where the real magic of Dow Theory kicks in. Think of it like a 4-act play that just repeats over and over and over again. You've got accumulation, then markup, then distribution, and finally markdown. And if you can figure out which act we're in, you'll know exactly how you should be playing your cards. So Act 1, accumulation. This is what happens right after a big market crash. The sentiment, it's just awful. We're talking fear, pessimism, total despair. The news is terrible and the public is selling everything they own. But here's the key. Look at what the smart money is doing. While everyone else is panicking, the big institutions are quietly buying everything up at fire sale prices. So your job here is to start looking for those same kinds of opportunities. Then we move into phase 2, markup. This is the big one, the primary bull market. Things are starting to look up. Sentiment shifts from despair to rising optimism, and prices just start to rally hard and fast. For anyone who follows trends, this is the most profitable phase, period. Every single dip, every little pullback is a gift. It's your chance to buy and buy aggressively. After all that excitement, we get to phase 3, distribution. And this is the tricky one, the deceptive market top. The public is now feeling euphoric. FOMO, the fear of missing out, is absolutely everywhere. But once again, what's the smart money doing? They're quietly selling. They're offloading all their positions to the public who are just clamoring to buy. For you, this is a massive warning sign. It's time to take your profits and get very cautious. And that brings us to the final act, phase 4, markdown. This is the bear market. The smart money is long gone, and the public is left holding the bag as prices just crash. In this phase, you absolutely want to avoid buying new long positions. In fact, you might even look for ways to short the market. And then, the whole thing bottoms out and the cycle starts all over again with accumulation. Okay, so that's the theory, which is great. But the big question is, how do you actually identify which phase we're in right now? In the real world, let's get practical. Think of this as your market detective kit. A few simple things to check. First, always zoom out. Look at a 2-year chart to get the big picture. Second, pay close attention to volume. Are new highs being made on strong, powerful volume? That's a great sign of a healthy markup phase. But if you see new highs on weak, dying volume, that's a huge red flag for distribution. Third, what's the public sentiment like? Read the headlines. If they're all euphoric, it's time to be cautious. And finally, are key support levels holding, or are they starting to break? That tells you if the trend might be changing.
Let's make this even more concrete. We're going to take a look at a real-world trade example. We'll look at the Indian Nifty Index back in 2020 and 2021, and you'll see just how perfectly these phases played out.
So check this out. Back in May of 2020, right after that big COVID crash, the Nifty was in a textbook accumulation phase. Sentiment was in the gutter, but you could see support starting to form. Then fast forward to August, it broke out and boom, we're in the markup phase. Every single dip was getting bought up like crazy. By January of 2021, the index was hitting all-time highs. The media was screaming buy, and that's when we entered the distribution phase. The smart money knew it was time to get out.
Okay, let's wrap this all up into your own personal Dow Theory playbook. These are the key things you need to remember and can start using right away.
All right, here are the big takeaways. Rule 1, always know what phase the market is in. Rule 2, trade with the primary trend, never ever against it. Rule 3, phase 2, the markup phase, is your time to be an aggressive buyer. That's where the real money is made. Rule 4, phase 3, distribution, that's when you switch to defense and reduce your risk. And finally, the pro tip, combine this phase analysis with your favorite price action signals. That's how you build some seriously powerful trading setups. Because when it comes down to it, Dow Theory shows us that the market is always telling a story. Those charts, they're not just random squiggles on a screen. They're a narrative of human emotion, a cycle that goes from total despair all the way to euphoria and back again. The market is telling its story. The only question is, are you listening?